So if you're a high-income professional or high-net-worth investor and you've been considering investing in real estate syndications, then I want to explain some of the basics of real estate syndications in this video. The first thing discussed is what in the world is a real estate syndication? Is it even legal? Well, the short answer, of course, it is legal. And at a core, it's a real estate syndication is a group of people pooling their resources, time, money, expertise to purchase a large real estate assets. Frankly, it could be anything. You can syndicate anything, car washes, etc., and or self-storage, or even mobile home park. Now, why do this? Simple, because these are the kinds of properties that individual investors couldn't buy on their own. It's too big, they couldn't be managed. But by teaming up, investors can share in the cash flow, the tax benefits, and the appreciation and the lower risk of these larger assets. In fact, one of the most famous examples of real estate syndication is the Empire State Building. Yeah, in 1961, Helmsley and Malkin organized a syndication that allowed 3,000 small investors to buy into the property, with some paying in as little as $10,000 for a share. That's pretty cool. And that's the power of syndication. It democratizes access to investments that are typically out of reach for most people. Now, who is involved in a syndication? There are two main groups of people. One is the general partners, or GPs for short. They're sometimes called sponsors or operators. These are people who are doing all the work, all the heavy lifting. They're finding the property, evaluating the property. They're doing due diligence. They're securing the financing. They're executing a business plan. They're raising the capital, and they're managing the asset day to day. Now, GPs are essentially the project managers. They're responsible for making sure everything runs smoothly, the operator. Number two are the limited partners, or LPs, or passive investors. Now, this group provides the capital. They invest their money into the syndication, but they don't have to deal with the headaches of managing tenants, repairs, property managers, or any kind of operational tasks. Now, in return, the limited partners receive a share of the profits, then the cash flow distributions, the potential for appreciation when the property is sold, so that's a profit. Also, the depreciation, the tax benefits of that. Now, unlike rental properties or businesses, it's truly hands-off investment for the limited partners, which is why it's so appealing. Also, limited partners don't have any liability that the general partners have, which is why it's called limited investors. All right, so now who can invest in a syndication? Now, real estate syndications are typically open to accredited investors. Now, what in the world is that? The SEC defined it, it's someone who either has an annual income of $200,000 individually, or $300,000 after filing with their spouse, or has a net worth of at least $1 million excluding their primary residence. Now, some syndications are offered to what's called sophisticated investors. Of a 506B offering, you don't have to be accredited, you have to be sophisticated. And that means that they don't necessarily meet the income or net worth requirements, but they have enough knowledge and experience to make informed decisions about alternative investments like real estate. Also, one difference with 506B is that the operator can't advertise to the public. It has to be pre-existing relationships with sophisticated investors. Now, why invest in multifamily syndications, right? It's very popular because of the numerous benefits they offer. There's at least 5 big reasons that investors want to invest in alternative investments in general and real estate specifically. Number one is the below average risk. So unlike single family homes or even the stock market, multifamily properties are incredibly resilient. For example, during the 2008 recession, delinquency rents on single family loans were 4%, where multifamily delinquencies peaked at just 0.4%. People always need a place to live. And that makes apartments more recession resistant. Also, if 1 or 2 tenants don't pay the rent or move out, you're still cash flowing. Whereas a single family house, they move out and everything is gone. So I like the risk of that, especially when you get larger as well, right? The break even point is very, very low. There would have to be a major problem for the property not to at least cash flow positive. And I do like the way it behaves in recessions. Number 2, above average returns. While the stock market over the last 20, 30 years averaged around 7 to 8% before fees and taxes, multifamily syndications routinely deliver 10% or more on average annual returns, typically even more. And those returns are consistent, they're predictable, and not nearly subject to the same volatility as a stock market. Thankfully, there's not a stock chart that goes up and down, and it creates a lot less stress. Number 3, syndications actually provide passive income. This is one of the biggest draws, right? You invest your money, general partners do all the work. In return, you receive regular cash flow, distributions, basically mailbox money. Now, with stocks, et cetera, you don't really have that unless you're doing very advanced stock option strategies. So passive income is a big appeal. Number 4, extraordinary tax benefits. They really come through something called depreciation, with all real estate has, but it's something called bonus depreciation, which allows you to accelerate the depreciation, not over 27 and a half years like with a normal house, but you actually get it much sooner because we're doing something called a cost segregation, which costs money. You normally wouldn't do it on a house, but on a commercial property, you pay $8,000 for it, and you can accelerate the depreciation, which means you can pass most of it along in the first 5 years. And this means that your cash flow can be entirely tax-free because it's going to show actually a loss in your K1, which is pretty cool. Now, at the end, you got to pay the piper, right? You got this capital gains, you got this recapture thing, and you got to deal with that if you do take the depreciation. But you can do something called a 1031 exchange at the end, where you can even defer taxes further. So if you use some of these readily available tax benefits, you could either pay very little or no taxes on your real estate at all. Number 5 is an inflation hedge. I really like this a lot, and we saw this recently. Really, if inflation goes up, why would the investment go up? It doesn't affect the stock market. Theoretically, it should affect precious metals. It eventually did. It was much delayed, but with apartments, for example, back in 2022 and 23, when inflation increased to 9%, rents were up 25%. Right, so everything's going up. Cost of living is going up. Okay, that's bad for the average American, but for apartment owners, which are limited partners and general partners, rents going up 25% when they normally go up 2.5% is wild, right? Increased valuations, crazy. So therefore, if we get another bout of inflation, it's likely going to raise rents again, and therefore the valuations. So the higher the inflation goes, the higher the rents go, and the higher the value, and so forth, the more your investment is worth. So if your investment is going to be worth, let's say, 15% average annual return, with inflation, that return could be 25%, therefore making up for that inflation. Really love it. That's why multifamily syndications make for the perfect inflation hedge. So what are the risks? Nothing is without risks, and there are some potential downside of syndications and real estate in general. But also, we're in the risk management business all the time. I'm going to show you also how we mitigate them. So number 1 is any investment can be sensitive to market cycles. So, and real estate is no exception to that. Now, you can mitigate this risk by investing in real estate like apartment buildings, which historically perform better than any other real estate type. Certainly, retail is up and down. Most recently, office is crazy, right? It also depends a little bit on where you invest. West Coast, New England, for example, very strong up and down cycles. You can make a tremendous amount of money when it's going well. I mean, you can lose all of it as well. So we tend to invest a little bit more in stable areas like the South personally, but there's also in the Midwest, stays away from some of these peaks and troughs. Another risk is that they're highly dependent on the operator. Having the right team in place to run a property is crucial to the performance of any real estate, and multifamily specifically. So if you're dealing with an inexperienced or incompetent operator, they're going to make some mistakes, especially in challenging times like we've been through, and those mistakes can cost you a lot of money. So to mitigate that risk, ensure that you're investing with the right sponsors with a strong track record of full cycle deals. Lack of liquidity is definitely a drawback, right? Because they're tying up your money for typically 5 years, sometimes 7, but typically 5 years. You can't just call up your broker and sell your position. Right now, on the other hand, many syndications can refinance before the end of the term and turn part or all the investment. That's pretty cool. But in the meantime, you're likely getting cash flow, you're building appreciation, and it may be worth it to tie up your capital for that period of time. Lack of control is definitely a downside. So not only is your money tied up for 5 or so years, but you can't control the investment yourself. Your operator does, which is so important that you invest with the right operator. But again, there's an upside because they make all the daily decisions and you don't have to. But if you're a control freak, this may be an issue for you. On the other hand, that's also the benefit of being a passive investor. You don't have to do anything, just leave it up to your trusted operator. Right. And of course, now the other question is, how much control do you really have over the stock market? Right. Just saying. But the difference there is you can sell whenever you want. One downside could be that it's harder to understand than stocks. Now, it may seem that understanding an alternative investment like real estate syndication or oil and gas is harder than stocks. And yes, there's a bit of a learning curve, but it's not overwhelming. But there's a little bit more of a learning curve, but I think it's worth it. On the other hand, who really understands the stock market? You might think you understand the stock market, but do you really? Right? Now, most investors should try to understand the market, but most don't take that time. And they just simply turn their savings and investments over to a financial advisor, and then they believe that they will take care of them. But of course, the truth is your financial advisor gets paid whether whether they make money for you or not. The difference here, fundamentally, whether you invest in stocks or alternative investments, take a little extra time and learn the investment. Learn what stocks you're investing in. Make it your business. And then number two, take a little bit of time finding the right operator and then asking some questions. You don't have to be an expert in the asset class, but to do the questions and to do the answers you're getting, do they make sense? Does the business plan make sense? Does all of this stuff make sense when you ask questions? Are they asking questions truthfully? Are they hesitating? So yes, spend a little bit more time when you're getting into alternative investments, but you don't have to be an expert. In conclusion, real estate syndications, especially multifamily, offer really a unique opportunity to invest in large-scale income-producing properties without the headaches of being a landlord, getting access to property you would never be able to do on your own. You got below-average risk, above-average returns, it's passive income, you got extraordinary tax benefits, protection against inflation, and they are truly unique and one-of-a-kind, and I think one of the best investments available. It should be in everyone's portfolio, in a good risk-adjusted portfolio that's diversified. So if you want to learn more, then visit us at nighthawkequity.com. We have an ebook there that gives you more detail on real estate syndications, but we'd also love to have a call with you, right? If you're looking for alternative investments, we'd love to build a relationship with you and then give you access, be one of the first people to look at some of our upcoming opportunities that we have. So we'd love to help you start your journey toward financial freedom. Thanks for watching, and don't forget to like, share, and subscribe for more insights on real estate investing. All right, see you next time.